Hello, everyone. My name is Mike Helton, a tax shareholder at Rivero Gordimer and Company. This is John Stein, an audit shareholder at the firm. We are a local CPA firm here in Tampa, Florida, and we wanted to present a webinar on the Consolidated Appropriations Act of 2021. The bill, which was heavily passed back and forth for quite some time and discussed, was named Consolidated since the bill contains almost 5,600 pages of information and combines many acts. We were paying attention to this for many days back and forth in December with regards to year-end tax planning, and it was finally signed or passed by the House and Senate on December 21st, and then signed into law by the President on December 27th. Two parts of this act that we are going to discuss in a little bit more detail is the COVID-related Tax Relief Act of 2020. And in that, Section 276 is the clarification of tax treatment of forgiveness of covered loans. Alongside that, what John and I are going to discuss today is the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act, otherwise known as PPP and Round 2 of PPP. We're also going to discuss the Taxpayer Certainty and Disaster Relief Act, which comes with that, many extenders and other tax matters that will be discussed later by our other partners, Kevin Bass and Jim O'Connor. Just this week, 2 interim final rules were submitted by the SBA and Treasury. The first one basically implements the rules and guidance that was promised in the Act. So the Act gave us 10 days, gave SBA 10 days to issue guidance, which we've been waiting on. That came out 2 days ago. So we've been waiting on this guidance, and now it came out. So the guidance provided a document for us to follow that gives us rules with regards to extending and reopening PPP, as well as the PPP second draw, or the second round of PPP. Within the Act, the Economic Aid and Hard-Hit Small Businesses Act, keep in mind the PPP rules are generally the same as they were before. So many of you have already borrowed from PPP Round 1, and now you're looking at, can I borrow again for Round 2? Many of you have been following this just like we have. So we want to provide some of the guidance and some of the ground rules that you'll be following with regards to the rules that we need to pay attention to. Generally, the rules are the same as before with some slight changes. The EIDL advances, which reduced your PPP loan forgiveness before, will now not forgive or reduce the PPP forgiveness. PPP 1 loans are still available to an original borrower who did not accept the full amount previously approved, or a borrower who returned all or part of the original dispersed funds. So before you plan to borrow Round 2, or before you plan to go back to and take a bigger bite at the apple for Round 1, you might want to pay attention to some of these rules. Remember, the programs 1 or 2 are only open until March 31st. And before you can borrow for Round 2, you must spend all of the money for Round 1. So you cannot apply for PPP 2 without having first going through PPP 1. So you do want to keep that in mind. Some things that stayed the same: the loans are still non-recourse. So they are guaranteed by the government, not by you, the borrower. So there's no collateral required. But the same rules still apply with regards to FTE requirements and pay rates. The safe harbors for FTE still apply. The only thing that this rule changed is it did expand the dates for which FTEs must be restored, which is basically now to the end of your covered period for PPP Round 2. So a little bit of background on the funding. The new PPP rules and this act allocated $284 billion for the program. Within that $284 billion, $15 billion is to small community lenders, small banks, underserved areas. With the first 2 days, which was issued by SBA the other day, actually yesterday, SBA's first 2 days of funding for PPP Round 2 will be totally dedicated to minority, veteran, and woman-owned businesses. There is $35 billion of that 284 allocated to first-time borrowers, which includes $15 billion for borrowers that with 10 or fewer employees, and loans of less than $250,000. The remainder of that amount, the $35 billion, is to those that never applied or could not apply before. $25 billion of that was allocated for second draw loans for small borrowers with 10 or fewer employees. So you may remember with first round of PPP, it was like the great gold rush. You know, once the doors opened and you could apply, everyone ran in, large, small, publicly traded, non-publicly traded. The SBA has done a better job this time at trying to control who gains access to funds first, and really trying to focus some of those funds on the smaller businesses and the harder hit areas, and definitely the harder hit type of industries. So some more rules with regards to the new act. Publicly traded companies are no longer eligible for PPP loans. Businesses not in operation on February 15th of 2020 or before are not eligible for a PPP loan. Guidance released, as I mentioned, in the form from SBA and two interim final rules, or IFRs, as we refer to them. It does expand non-payroll costs. And now we'll get into that a little bit more in a minute. There's 4 new spending categories for non-payroll costs for first or second loan forgiveness applications after the enactment of this act. Again, it did extend this program to the end of March. So, you know, here we are, not even to mid-January yet, and the program closes on March 31st. So again, I have a feeling that as soon as the banks open and start funding these loans, there's going to be a great run to apply. So the reason we wanted to get this video out is so that you can become more informed and identify whether or not you qualify, or when you qualify for this round. Additionally, they did create a simplified process of a forgiveness application for original loans of $150,000 or less. So you may recall before they actually came out with a forgiveness form 3508S, which simplified the process for loans $50,000 or less. They have not released the forgiveness form yet for $150,000 or less, but they may expand that 3508S to include loans $150,000 or less now. But we're still waiting on some more guidance to see where that goes. Some of the rules and the framework that you have to stick to, again, remember, with any PPP loan 1 or 2, it's still a requirement for your eligible cost for forgiveness to be in a 60-40 split between payroll and non-payroll costs. Non-payroll costs, if you'll recall, are mortgage interest, rent, and utilities were the common 3, but now they've added 4 new categories to non-payroll costs that can be captured and spent with PPP funds that will qualify for forgiveness. 4 categories. Bear with me here because these things are in great detail in the IFRs, but I'm going to quickly summarize them. Covered operation expenditures is one category, which is basically business software, cloud services that facilitate business operations. Covered property damage costs. So cost regarding property damage, looting, vandalism, those type of things are now covered with PPP funding. Covered supplier costs is very broad, but the rules you'll need to read just to be careful. The definitions basically costs essential to the operation of the business. Well, most of you are thinking, well, that's everything. All of my costs are essential to my operation, and I get it, that's true. But this category does not capture everything. It's more in the supplier and inventory costs of what you're trying to maintain and sell. Covered worker protection expenditures. So just think PPE, personal protection equipment, and things that will protect you, your customers, your employees, and provide safety precautions for COVID-19 expenditures. So those 4 categories are now new in the non-payroll costs. Part of the Paycheck Protection Program now is businesses for 501c6 organizations. And John, I don't know if you want to add anything with regard to C6 organizations. I know you probably deal with them more than I do, but they were not part of the original PPP
Correct.
loan program, right?
Correct. We had a lot of questions on that at first. A lot of people thought they qualified, they didn't. But on the second round here, with this correction, that 501c6 organizations are eligible now.
Now, 501c3 organizations were always available.
Correct. And they're eligible now as well.
Okay, and I know we have a couple clients and a couple of groups, I guess, that we represent that are C6 organizations that have been waiting for this news. But now the C6 organization can borrow from the PPP program. We think it's still going to be a PPP Round 1 program, not 2, because, again, they were never eligible for PPP 1 to begin with. So you can't have a PPP 2 loan without going first through the PPP 1. However, they only qualify for groups that have less than 300 employees, and they've added a couple other exclusions to that list. They cannot have lobbying activities. So you can't receive more than 15% of your gross receipts from lobbying activities, and your total lobbying costs cannot exceed $1 million in the most recent tax year. So there are little carve-outs for C6 organizations, but by and large, most of them, at least the ones that we know, will now qualify, which was good news. A little bit of information on payroll costs. Payroll costs pretty much the same as before. It's not been changed. So within these rules, if something hasn't been changed, it is the same as it was before. And with these IFRs, one of the quirks with one of the interim final rules that came out is it consolidated all of the previous IFRs that were written with PPP1 into one document. So it wasn't voluminous. It was about 45, 50 pages long, but it did mention that it's consolidating all the previous rules into one body of rules now. So we are consolidating some of those rules. So payroll costs and all of the rules that went with it are the same as it was before, still capped at a $100,000 annualized base, and the owner's limitations are still going to be the same. However, one difference, in addition to the cash compensation, which was cash, retirement, health insurance, the new legislation has now allowed group policy insurance benefits to include life, disability, vision, and dental. So along with just regular group health, you're also allowed to have some of these other group benefits, which I think many companies probably provide, which will be good for those that aren't already paying enough in cash compensation to meet that at least 60% threshold. And those changes qualify for loans before, on, or after the date of enactment, which was December 27th of 2020. I will remind everybody, because I'm still getting questions on this from time to time with regards to PPP Round 1 forgiveness applications, it's for W-2 wages only. So 1099 contractors do not count as part of your payroll costs. 1099 contractors and self-employed individuals will apply separately for themselves. So you do not count your 1099 contractors as part of your payroll costs. It's only what shows up on a W-2. So John, do you want to talk a little bit about the second round draws and who can borrow and some of the rules that we're playing with now?
Yeah, sure. Absolutely, Mike. And one of the questions we're already starting to receive a lot of questions now. They hear all the news out there is, do I qualify for a second round of PPP loans and who's basically eligible? I'm going to touch on that here. So basically, right now, some of the eligibility requirements is that you have to have less than 300 employees On the first round, it was 500. Now it's gone down to 300. And then this is actually tested by location for NICS code 72 entities, which are essentially like food service, hospitality, restaurant type industries. That's actually tested on a location basis, actually. The next step is, once you meet the employee test, is that what you need to do is you need to take a look at your 2020 revenue by quarter. And then what you need to do is compare it against your 2019 revenue by quarter to see if you have a revenue reduction just in one quarter that dipped below 25% as compared to 2019. So again, just laying out your quarterly financial statements from year to year, seeing if you have a dip of 25%. So then the next catch here is you have to expend all your PPP Round $1 before you apply for your PPP Round 2 funding. You don't have to apply for forgiveness, but you, as Mike had mentioned, you have to expend all your dollars that you previously applied for before. And Mike had touched on some of the ineligible entities who cannot receive PP funding, such as publicly traded companies, hedge funds, private equity firms, or if you're in bankruptcy. They've also added in now, too, if you've been engaged with political and lobbying activities with those and or affiliated with China, are not permitted to receive PPP Round 2 funding. One of the things that we kind of talked about when we saw this kind of come first out, and us being accountants, we always want to know.
This is what causes our mouth to water a little
bit,
right?
This is. It sounds it sounds relatively easy. Your gross receipts and your revenue, but us as accountants, we have probably about 6 or 7 different ways of calculating revenue, depending on what you want to be taxed on and how you want to account for it. But basically, they came out with the ruling now is it includes all revenue from whatever source is received or accrued in accordance with the entity's accounting method. So this basically means sales, interest, dividends, rents, royalties, fees, commission. And basically, how the organization normally keeps their accounting records is how you should apply and look at the quarterly revenue from period to period. Some of the things that are excluded are some of the big items that are excluded. If you had any capital gains or any capital gain transactions, those would be excluded. And then Mike also mentioned, we have pointed out there as well, too, if you had applied for PPP loan forgiveness and have that income included in your 2020 financials, that would actually be excluded as well, too, and would not be counted in your 2020 income there.
So basically, they throw in the kitchen sink to everything that's income, with the exception of non-recurring big items like capital gains and the PPP forgiveness.
Correct. Exactly. They got a whole detailed list out there, but those are the big exceptions for the most part. And I think the other little thing, too, is your EIDL loan advance, even though for most groups to be relatively small, that would also be excluded.
So, John, let me ask you a question. I mean,
Sure.
We were having a discussion earlier about this. If I have a set of books that's accrual method, but I'm a cash basis taxpayer, does it make sense that if I'm going to look at a quarter to quarter or compare tax year to tax year, what would I do with like you mentioned, we've got several methods of accounting going on. It seems like consistency, as long as I'm comparing a consistent period, one method versus one method, that would make the most logical sense.
Yeah, and typically what I would envision too now is if you normally keep your books and records on the accrual method for 2019 and 2020, I would compare it and consistently compare period to period in that fashion.
Okay.
So I think consistency is the key there.
Yeah, okay.
Just some of the gross receipts substantiation. One of the things that, and I'll touch on the top part there in a minute. So basically, if your loan is less than $150,000, you don't have to prove that revenue reduction on your application, but you do have to prove that when you submit for your loan forgiveness. So you have to eventually prove that you had a revenue reduction, but it's a little bit easier if your loans are less than $150,000.
So trust but verify.
Correct. Trust but verify.
Afterward.
Exactly. So if you fall into the larger category, so if your loan's basically between $150,000 and $2 million,
there's no trust.
Yeah. They want to see your financials on the front end there. And then what we would envision that the banks or the lending entities want to see is more than likely your quarterly financial statements, your bank statements, and even various tax forms as well, too. More than likely probably your 941s or something to that effect. Okay, then the next step here is once you figure out that you're able to qualify, then it's how much can I borrow, basically. And this is pretty similar to the first round of PPP loan funding. Basically, you're eligible for the lesser of 2.5 times your monthly payroll costs. You have two options here, and there's a little bit more to that, and I'll get to that in a minute. But basically, it's 2.5 times your payroll for the 2019 year or the period preceding your loan application or your 1-year period. There's a nice little kicker, as I'd mentioned before. If you fall into the NICS classification 72, you get a kicker of 3.5 times your payroll. So obviously, entities that are more impacted from the COVID, you get 3.5 times there. Like we had mentioned, includes hospitality, entertainment businesses, hotels, casinos there.
Restaurants.
Yep.
Yeah.
So they're going to get a better piece there. And then also, if you exceed that, the cap on the loan is basically $2 million. Your first PPP loan remains capped at $10 million. And then also, if you have a consolidated C Corp, you're eligible to receive no more than $4 million on a consolidated basis in the aggregate. As I had mentioned there too, one of the things that you kind of want to look at, maybe plan a little bit of strategy and kind of looking at your payroll costs for the most part. Basically, you have three different options there. You can look at 2019. So if you use 2019, your PPP loan is going to be essentially your PPP Loan 2 is going to be the same as PPP Loan 1. You can look at your calendar year 2020, which sometimes that's probably the easiest if you got W-2 wages and all those things already sorted out. Or you can use the trailing 12-month period prior to the loan date, other than self-employed borrowers for the most part. So obviously, you want to look at what yields the highest average monthly payroll there. The new application form is called 2483 SD, which stands for second draw, and we imagine that will be available shortly. So then the next step is how does the forgiveness work on this round? And for the most part, it's essentially the same as the first round, basically. It's going to be the lesser of your total payroll costs plus your non-payroll costs. They're basically the actual dollars, actual qualifying dollars that you spent your PPP loan on. Obviously, it can't be more than your PPP loan amount. And then this last little item that we have listed there is your payroll costs divided by 60%. And basically what that's doing is it's mathematically proving that you basically spent at least 60% of your PPP loan dollars on payroll. So again, you got to spend at least 60% on payroll. But from our experience, Mike, for most of our clients on average, they spend essentially most of it or a good bulk of it on payroll. So that's usually not an issue for most of our clients here.
That's right.
And the one exception here, which I pointed out before, if you were less than $150,000 in your second round loan, basically at that point in time when you apply for your forgiveness, you have to then prove your revenue reduction there as additional documentation. The covered period, they kind of cleaned this up as well too. The covered period basically relates to the time you have to expend your PPP loan dollars. Sounds pretty straightforward, but there's a little bit of confusion on the first round.
There was a lot of confusion on the first round.
Yeah, so it sounds pretty simple at 50,000 feet, but when you start getting into the details, you can start getting a little bit confused. But effectively, from the time you get your funding, you have basically 8 to 24 weeks to spend those dollars on qualifying expenditures. And on the annualized compensation, basically you'd annualize the $100,000 compensation cap over the time period that you spent those dollars. So obviously, I think if 24 week period, I think you're capped at about $46,000, and then you would prorate that downward depending on the time period you spent those dollars. But basically what had happened on the first round is we had people after about 10 or 12 weeks, they spent all those dollars, they wanted to apply for forgiveness, and they weren't sure if they could apply for forgiveness or if they had to wait for that 24-week period to end.
This makes things so much more flexible and easier to compute, because now it's you spend the money, And when you're done, you're done. You apply for forgiveness, and
Yeah.
all of the rules and all of the proration happens at that point in time. There's
Correct.
no, okay, I'm in an 8-week period or 24. Can I be in between? This throws all that confusion out the window, which
Yeah.
I thought was very good.
Yeah, and the one thing too, obviously, I know at first on the first round, there's a crunch to get all those dollars spent within that 8-week period. But for the most part, with that 24-week period, we find most people have no issues expending
You are,
those
because
dollars.
you're borrowing off 2.5 months of average
Yeah.
payroll, and the 24-week basically gives you 5.5 months to spend it.
Yeah.
So it's pretty flexible, which was why we had the Flexibility Act before.
Yeah, I think that pretty much covers it. I'm going to turn this over to Jim O'Connor and Kevin Bass here for our next segment, and we'll go from there.
So thanks to Mike and John for that excellent update on the new PPP loans, PPP Round 2. I'm Kevin Bass, tax shareholder here at Rivera Gordimer Company. This is Jim O'Connor, also a tax shareholder here at Rivera Gordimer Company. And we're going to follow up on some of the other aspects of the new act. I'll get into a little bit of the tax treatment of the forgiveness of the PPP loans. This was something that kind of went back and forth, Jim, if you remember. All summer, the PPP loans came out. Everybody applied for them. The original intent were they're going to be tax-free. The IRS then came back and said, yeah, they're tax-free, but the expenses will be not deductible. Kind of a nudge to our government to get something done. And finally, in this act, it was passed that the original intent of the CARES Act were that the PPP loans were not going to be taxable. Additionally, no deduction generated or funded by forgiven PPP loans will be denied. So all the expenses, the payroll, the rent, the utilities, anything used with PPP money will now be deducted. No basis issues. There was also some concerns on any basis issues with this non-taxable income. That was resolved, and that pretty much was done with Rev Rule 2021-2. It makes obsolete IRS Notice 2020-32 and Rev Ruling 2020-27. So anyway, a lot of that back and forth all summer long finally got resolved, and we can move on.
Yeah, that was a big relief to our clients. A lot of our clients were sort of left up in the air, and this sort of put our minds at ease after this.
It really did. I mean, it made tax planning tough. Which way do you include these in income? Do you not include them as income? Finally got that settled, so we can move on there. Other tax stimulus matters is the extension of the credits under the paid sick and family leave. The FFCRA, it's now extended till March 31st of 2021. That was some credits, if you remember back in the original CARES Act, for paying either employees that were out sick or paying employees that were furloughed due to government shutdowns. That's now been extended to March 31st, 2021. Also, the additional credit against tax, the $600 for single, $1,200 married filing jointly. Remember, that was the stimulus payments that were received. That'll be offset by any advance refund checks that were received. So that also got clarified in the act. One thing that obviously the big change is the employee retention and rehiring tax credit. This was huge in the original CARES Act. If you remember, though, a lot of people really didn't pay a ton of attention to this, right? Because if you got a PPP loan, you couldn't get the credit. So a lot of people were focused on the PPP loan, got the PPP loan. This kind of got pushed to the back burner. Well, now it's back, because now under the new act, you can do both. You can do the PPP and get the retention credit. Jim will touch on that a little bit more, but this credit got extended past December 31st, 2020. Now it's going to be extended to July 1st, 2021. It changes the cap on $10,000 annually to $10,000 a quarter. It increases the percentage from 50 to 70% of wages paid. And it went from a 50% drop in 2020 to now a 20% drop in 2021. And then it expanded to large employers from 100 to 500 employees. And I'll let Jim touch on some of the differences between 2020 and 2021 on this.
Yeah, so it's pretty complicated when you first look at it, but I think it really helps if you kind of break down, hey, what are the rules for 2020? And you'll see we've got some much more different rules in 2021. They're actually a lot more favorable. You'll see that it brings a lot more clients and taxpayers into the program. So for 2020, you got to figure out, do I qualify? So you either have to have qualified wages paid while you were shut down due to a government order, or you had qualified quarter if your gross receipts were less than 50% of the same quarter in 2019. So that's a pretty drastic drop to qualify for that quarter.
Right.
But if you do have that, you did have that drastic drop, your next quarter will automatically qualify until the end of the quarter in which gross receipts are restored to above 80% of the same quarter. So if you had a big drop in quarter two that was more than 50%, quarter two is going to qualify. And let's say in quarter three you rebounded to 100%. Well, quarter three is still going to qualify. So you're going to get quarter two and quarter three. And another big important thing is how many monthly full-time equivalents did I have? Because you'll see that kind of swings on whether this really has any benefit or has a huge benefit. Really depends on whether you're under this threshold or above this threshold. So for 2020, it's 100 average monthly FTEs. So if you are above that, what that means is that the only wages paid to employees not to provide services qualify. If less than that, then basically all your wages up to this cap qualify. So I kind of break that down into, let's say you're a restaurant, let's say post-pandemic, you basically had to move to a takeout business.
Right.
So you got the cooks in the back cooking. Let's say you had to furlough all your servers. So you're still paying all your cooks, but you're not paying any of your servers. So if you're above 100, it's really not going to benefit you because you're not paying anyone not to provide services. But if you're below it, then basically all the wages that you're paying to the cooks and to the takeout service will qualify. So that's a really important factor on where you fall on that monthly FTEs. So then the credit is 50% of qualified wages up to $10,000, which equates to a $5,000 credit for all quarters. So if you had the same employee in quarter two and quarter three that was paid $10,000, he's going to get capped at $10,000, only going to qualify for that quarter two $5,000 credit. Can be Zippo in quarter three. So let's swing to 2021. We'll see if we've got a lot more flexible rules. So we still have got qualified wages paid while we're shut down to a government order. But now we'll have a qualifying quarter if gross receipts are less than 80% instead of that 50%. So we're going to see a lot more people qualify versus that. And it's important, you're not measuring that against 2020. You're actually measuring that to 2019 quarter. So a lot of our clients had a drop from 2019 to 2020. So if you're measuring that 2021 drop, you're not measuring it to 2020. You're actually measuring it to that higher amount in 2019. So
Which makes sense because 2020 you would have had a dip with COVID with revenue being low. So you're comparing it back to the pre-COVID 2019.
Exactly.
So it should benefit a lot more people.
Should benefit
a lot more companies. Right.
Exactly. And then they increase the FTE threshold as well. So it's up to 500. So that same rule. If you're below that, basically all your wages will qualify for up to that 10 grand cap. And that, like you said, that 10 grand cap is for any quarter. So that is going to be first and second. And now the credit is 70% of qualified wages. So basically up to 7 grand credit for each employee you pay over 10 grand in quarter one, quarter two, if they both qualify. And also there's an option for small employers to receive an advance credit. So you don't have to wait till you file the payroll tax return to get it. You can actually file this form and get an advance of that credit based on up to 70% of your average quarterly wages. So that brings up a couple planning opportunities. So if you haven't submitted your PPP1 forgiveness application, you may want to, step one, figure out, hey, do I qualify for ERC for 2020? If so, I want to pause and I want to think about what I report from my payroll, because I may not want to just lump all my payroll in there and get 100% forgiveness that way. I may want to save some of that payroll, set it aside for the ERC, and then use my rent and my utilities to make up that balance. So
they're not going to let you double dip here.
They're not going to let you double dip here
on the same wages, exactly.
So it's a way you obviously want to get 100% forgiveness on your PPP, but if you can do that and save some payroll dollars that will qualify for ERC, that can be huge.
Right, you got to run the numbers there for sure.
But if you don't qualify for ERC, it really doesn't matter. This is really just that's sort of your first step. Do I qualify? If so, kind of pause, talk to your CPAs, see if this is a strategy to enlist. And then if you do qualify for ERC, you get a couple different options. One, you can go back and file those amended 941s to claim the credit, or that they are making sort of a streamlined system of where you can have a catch-up credit on this fourth quarter 941 and claim it that way, which should be a simpler filing process.
Right. So if you haven't filed fourth quarter of 2020 941, you can claim it on that. If you're seeing this webinar maybe after, maybe those have already been filed, then you can go back and file 941X returns, amended returns, and get those credits back on the 2020 forms.
Yeah. So now wages that you use for the ERC are not eligible for the R&D credit or the work opportunity tax credit or any other wage-related tax credit. But that's okay. The ERC is going to be more valuable than those credits, so it's better. You're better off getting it on the ERC.
Right.
A couple other tax and stimulus matters for 2021 and 2022. Meals are now 100% deductible instead of 50%. This is basically trying to encourage people to go out to restaurants and try to stimulate some of the restaurants that are hurting. So I think that's good.
Very good.
For 2021, they expanded this above the line charitable contributions deduction. So this is going to help taxpayers that don't itemize that have charitable contributions still able to benefit from that charity. Another interesting one is educator expenses now include PPE. So this is your teacher expenses that maybe aren't buying the supplies for the classroom that can still qualify for this deduction based on the PPE they bought.
PPE, right.
And then,
Personal protection equipment.
Yeah,
right.
personal protection equipment. And as part of the stimulus, there was a lot of extenders. Kevin's going to get in.
Yeah, there's three I just wanted to touch on. The 179D energy efficient commercial building deduction. You see a lot of architects, engineers, contractors be able to take advantage of those for a lot for commercial type buildings, especially in the not-for-profit sector. That's a permanent extension. That's nice. It's a nice deduction. If anybody has questions on that, want to follow up, let me know. The other ones we see, there's actually, I think, over 30 extenders. These are the kind of the big three that stuck out that a lot of our clients and people we do work with take advantage of. New market tax credit extended through 2025. The work opportunity credit extended through 2025 as well. Many more changes to come. New administration coming into office. The Biden administration. A lot more changes. Stay tuned, and we'll keep you abreast of the changes. With that being said, that wraps up this webinar. As you can see on the screen, for questions and answers, email info@rgcocpa.com. We'll try to get back to you as soon as we can. Obviously, call us or email us for the people you know personally here for questions on this. Info@rgcocpa.com will work. Please follow us on LinkedIn. We're on Facebook, Twitter. We also have a YouTube channel. Please follow us. Please like. Please follow. And that's probably the best way to keep in touch with what we're doing. We're going to try to keep these updated as we get information. We'll keep these channels updated. We also have a quarterly email newsletter. That's called The Bottom Line. You can go to our website and subscribe to that. That's a nice little behind the scenes on what we have going on here at the firm with updates as well. And then we just recently started a YouTube channel called Beyond the Bottom Line. So I think we've got 3 videos up on there so far. This will probably be the 4th once we post this. And our website's there. We appreciate you tuning in. And any questions, that's what we're here for. We appreciate it.